everyone. I'm Andrew with Jesani Wealth Management. And the concept or the approach using risk parity is really at the core of our three-dimensional asset allocation strategy. And what risk parity is it's a quantitative investment style that adjusts the proportion of assets within a portfolio based on their risk level or their volatility. And the objective is to achieve equity-like returns without equity-like volatility. Thus, you're avoiding the bad times in the market and outperforming during those times. Of course, you do sacrifice some of the upside in the good times, but by avoiding portfolio downturn, you need to thus make up less ground during the good times, which can lead to outperforming the overall markets in the long term, specifically in times of high inflation or low growth. A strategy using risk parity can be quite effective. But I wanted to discuss this because it has a strong relationship with our asset allocation strategy, which was kind of built on this concept, but tweaked and adjusted, and some asset classes have been added to even furthermore increase the return potential and decrease strategy correlation or decrease volatility. And on the topic of strategy correlation, if you haven't watched my video on strategy correlation, that really takes a deep dive and discusses why having assets in a portfolio that move opposite of each other at the same times can really be quite effective in reducing volatility and increasing return. So I'd suggest you watch that if you haven't. But Bob Prince, who's the chief investment officer at the largest hedge fund in the world right now, which is Bridgewater and Associates, said that risk parity equalizes risk by allocating funds in a wider range of assets. So what Bridgewater did, well, Ray Dalio, who you're familiar with, came up with the all-weather portfolio in 1996, which today is by far the most famous and largest risk parity portfolio in existence. And what he did is add in some commodities, add in some inflation protected, some tips, and some treasuries into the portfolio, and created lower volatility when the market does poorly. And like I discussed earlier, by missing some of that downside or the drawdown in a portfolio, you have a less drawdown, you thus can have better performance in the long term. Let me use a really basic example of how decreased volatility can actually outperform. So let's say you have portfolio A and portfolio B. Portfolio A, you start with $100,000, and in year one, the portfolio goes up 20%. Well, your portfolio is now worth $120,000. Now, let's say during year two, and at the end of year two, it drops 20%. That portfolio is now worth $96,000 versus portfolio B, again, $100,000, but let's say in year one, we just have a 10% gain. So we're at $110,000. And then during year two, and at the end of the year two, we have a 10% loss. Well, that portfolio goes down in value to $99,000. And you can see in this scenario, simply because of lower volatility and trading within a more tight range, portfolio B actually outperformed, being valued at $99,000 versus portfolio A, which had the wider volatility swings. That's probably the easiest way to illustrate how this model and this concept works. But I mentioned Ray Dalio in the all-weather portfolio, and what he was really looking at when he created this was the 60-40 portfolio model, the 60% stocks and 40% bonds, which unfortunately is still being used quite often today. And that model worked quite well, especially when bond yields were higher and the markets were doing well. But what he found was that 90% of the risk in that portfolio was within the 60% equity portion. So certainly you could add more bonds in and go 50-50, but you're going to sacrifice some significant returns by doing so. And particularly today, where the bond markets aren't really performing and they're not particularly attractive, there may be a better approach, which I'll discuss in a moment. But let's stick with the all-weather for now, which is less equity, more treasuries, some tips, and some commodities. And I want to show you how it's performed in the past several decades. So you can see the 60-40 model is the orange, the all-weather is the purple, and the S&P 500 is the blue. So I want to focus on times like the 1970s, which was a period of very high inflation, not too different from what we're currently seeing. And then in the 2000s, which was a period of very low growth, you can see that in those 2 decades, the all-weather outperformed. But of course, in the decades where we had high growth, either the S&P 500 or even the 60-40 model outperformed. Now, I think the 60-40 model no longer makes sense because of bond yields and rising interest rates. but I think I discussed that in the white paper on our multi-asset allocation strategy. But you certainly could make the argument that coming off the largest bull market that we've ever seen after the 2010s, right now we're in 2022, it may not make sense to use a 60-40 model, and the all-weather could be more attractive, and even more so our three-dimensional multi-asset allocation strategy because of the changes that we've made to it. But when Ray Dalio was looking at the key drivers of the market, of course, you have growth and inflation, and then you also have periods of negative growth and periods of deflation. So the all-weather model was designed to perform in any of those scenarios. So does it make sense right now to use something like an all-weather model where you have, about 40% in stocks, about 50% in treasuries or tips, and then 10% in commodities or other asset classes? And I think the answer is probably not, for the reasons that I've already mentioned. But what we've done in our three-dimensional multi-asset allocation is, one, we've replaced some of the equity with private equity, which I discussed in detail in the video on private equity, has a lower standard deviation, so lower risk, and a higher return potential at the sacrifice of some liquidity, which is an issue for most investors. So we've enhanced the growth portion of the portfolio, and then we've replaced the fixed income portion or the bond portion with other alternative assets with similar risk profiles and better yields. For example, private credit, same risk profile or very similar to bonds or maybe even treasuries, but an average return of about 8% versus bonds where we're seeing about 3.5% right now. Or real estate, whether it's a real estate syndication or a REIT, averaging anywhere from 7 to 15%, again, as a replacement for the bonds at a similar risk level, and adding another non-correlated asset into the portfolio to reduce drawdown potential, therefore reduce risk. Also in the equity portion, structured notes, where instead of buying individual equities or ETFs, we may include structured notes that have a predetermined yield of 12, 15, 16% based on equities, but that have significant downside protection of 30 or 40%, which in and of itself reduces overall volatility in the portfolio. And then, of course, investments that are fully principal protected, meaning zero risk, like a fixed index annuity, where you're sacrificing some of the return on the upside, but again, dramatically reducing volatility in the portfolio by having zero downside. So these are some of the things, the tweaks and changes that we've made to the concept of the all-weather portfolio that have taken it to the next step, taking into consideration what the next decade may look like. No one really knows, but we know what the last decade looks like, and we know what difficult times in the market or high inflation or low growth look like. And you certainly could make the argument that we're approaching a period or cycle in the market that may not look so great, which would certainly make the case for the all-weather portfolio, and even more so make the case for our three-dimensional multi-asset allocation strategy, which kind of builds on that and increases the return and lowers volatility. So if you have any questions or want to go into some more details about any of the asset classes we're using, certainly reach out to me. My name is Andrew Constantinidis with Jesani Wealth Management, and you can reach me at any time at 954-800-8552. Thanks, everyone, and take care.